It's episode number 3. It's January 10th. And today I'm just going to be updating the portfolio after 1 week just to see where we're at, as well as uh, going to be going over the top 5 mistakes that I see a lot of new investors make. So why don't we just get into it real quick? So I've already put in the numbers here. This is for January 10th update. Oops. Let's try that. So today is Jan 1, 2021. Or no, January 10th, 2021. All right, so you can see that Bitcoin moved up a bit. This actually went as high as I think like 43,000 or something over the week. It's been just crazy. I looked at this at Bitcoin over 20,000. I thought it was a good time to start making it as part of the portfolio once it passed that previous high that it did a while back at 20,000. But since then, it's just had an extreme run up, a little bit too fast in my opinion. Gold, you can see here, it's kind of with the 100 shares, it's dropped a little bit. There's been some deflationary concerns or that came up over the past couple of or past week because of the unemployment numbers being a little bit high and other things. The Chinese ETF FXI did a little bit better. Then here the S&P has done fairly well. Tips, obviously, this goes along with gold, and I think this will eventually work out over the year. But obviously, we're not going to make any changes to the portfolio. But you can see that it's dropped just slightly. Married Vacations has done a little bit better over the week. Looks good. Wyndham, very good. 21,245 versus 20,187 before. Extended stay looks like it dropped a little bit. The Dogs of the Dow, again, they're doing okay, but this is more for a yield play. And then cash is cash. So this is the final tally: 1,017,284. So that's about a 1.7% gain for the week. All right, let's go on to the top 5 mistakes that people make in investing. This is really important because after 30 years of investing, you've seen all the ups and downs, and you've made tons of mistakes, and hopefully I've learned over 30 years what not to do when investing. So number one is selling too early. So a lot of times people, they see like a profit in their positions and they just immediately sell because they're afraid of losing their gains. That's a terrible way to approach things unless something like major happens, for the sector, or if something in general occurs that could bring your total portfolio down. I would never sell too early. Not only because you're going to have to suffer possibly not getting bigger gains over the long run, but also having to pay some higher taxes over the short term. Meaning that if you're going to sell a position less than a year, you have to pay a lot more because in capital gains, because the tax man does not want you to be selling and trading things on a regular basis because that is actually going to be considered as part of your income. So it's going to be taxed at an income level rather than be taxed on long-term capital gains, which is much lower. So the second part of this is selling too late. A lot of people spend too much time holding on to their losses, and they just see those losses go down precipitously. And so you will really want to be able to avoid selling too late and just really trying to protect your initial principal. So the one thing that happens that I've noticed in terms of selling too late is that some sort of big event occurs. This goes to number 3, but I'll talk about that a little bit later. But you really want to be able to protect your initial principal. So, it's fine if you lose anywhere from 5 to 10% on a position. That's going to happen. But if you start to go into that 20, 30, 40% losses, you have to understand that if you lose 50% of a position, you essentially have to make a 100% return to be able to get you back to even. So you really want to limit those losses to, I would say, anywhere from 5 to 10% on a single position, just so that like it doesn't affect, your overall portfolio. All right, so number two is paying high fees. I brought this here. You can see this is a great example of a low fee ETF from Vanguard. Vanguard has a lot of, um, oops, let me go and make sure I float this on top. So you're always seeing me. So Vanguard, you can see here. Sorry, this is really raw, my recordings, but that's what I plan on doing pretty much for the foreseeable future. Because I just think this is just a better way of doing it, because it really allows you to be able to just follow along in real time about making these kinds of investments and making sure that you're getting information that's true, rather than all polished and crap like that. All right, so Vanguard I think is a great. They have a great number of ETFs. You saw that I was actually in SPY. The reason why I just do SPY, and if you look at SPYs, and I'll show it up real quick, the expenses are really low, but the reason why I use SPY is because the liquidity part of it, it's got to be one of the highest ETFs that's traded. It's very, very liquid, meaning that the bid ask price is very, very tight. So you know that you're going to get good execution if you try to sell your positions. All right, so here you can see here for Vanguard, really low expense ratio, 0.03%. This is what you want to see. You want to see stuff that's below, like below 1%, because there's no reason why you should be giving somebody else, your money, because that's just going to eat into your profits. Just to show, what SPY looks like relative to Vanguard, 0.09. Again, not a huge difference in expense ratio if you look at the grand scheme of things, but it is higher than Vanguard, but just by a little bit. It's, to me, it's minimal, but definitely the reason why I hold on to SPY or trade in SPY is because of the liquidity factor. Okay, so number three is denying exogenous events. Okay, so a lot of times, these are kind of events like what happened in 2008 in terms of the financial crisis. We just went through this in 2020, with the pandemic. You start to see from a lot of these media outlets about a little bit of a talk of certain big events that happen, and then a lot of people are going to say, oh, this is not as a big of a deal as it sounds. But once these things start to happen and start to roll, they go down in a big way, in a very quick manner. So you want to recognize these kinds of exogenous events and prevent them from really affecting your overall portfolio. But I do think that being able to recognize like a 9/11 event as more as a buying opportunity, I think is the best way to look at it. So keep a keen eye, not only on to protect your principal, but also following these really big events to be able to take advantage of the eventual upswing that always occurs, in these kinds of events that you can really profit from. So I always find these as like very opportunistic times where you can take advantage, of when the overall investor pool is extremely scared. Those are the best times to be able to jump back into the markets. Okay, so number four, trading instead of investing over the long term. God, I mean, I could go on forever about this, but there's a lot of people that spend a lot of time, way too much time every day, trying to time the markets. And these guys are traders, day traders, even like minute by minute. I've found that these guys do not perform any better and actually perform a lot worse than people who end up investing for the long term. So the way that I look at it is that, if you feel uncomfortable putting all your money at the same time into the stock market, just do. Some people call it dollar cost averaging. I don't really like that term either. Like what I usually do is that, let's say you have $1 million or 100,000 or $10,000, and you want to trade it, over like a 1 year period of time, then, just slowly go into it, but go into it whenever you see like a big, or not so big, but like maybe a 1% or 3% kind of drop, in the markets, and then buy it on those dips. So again, over the long term, because all this is for long term holds, meaning more than 1 year, then you're really not going to suffer all that much, because you're buying into weakness, which I really emphasize a lot. And I think that that's the best way to be able to trade over the long term. Sorry, not trade, but invest over the long term. And I think you're going to find that to be the best approach towards investing. Okay, so number 5 is just watching like CNBC, or God, there's countless amount of, I mean, heck, you can see here, like, you go to the Yahoo Finance home, and you're going to see a million different stories, or you go to CNBC, and you're going to see all these stories that you can follow up on, and you can just get lost in. I would not be spending a lot of time reading a lot of these articles, because it can just get you into analysis paralysis, and you just don't want to be there. Again, the other part of this is marketing, or just financial gurus. I put here marketing because I think a lot of times these guys spend most of their time trying to get you to buy their books and crap like that. That gets you nowhere, and that's how actually those financial gurus start to make money, is just by trying to sell you something that you don't need. Again, I think that the best way to approach this, going back to my portfolio, is just buy some major indices, like the S&P, hold them for the long term, and you're going to come out better at the end. All right, that's it.